Hello and welcome to Buy Africa, the show where we focus on investment opportunities around the continent. I'm Tapo Mudiba, and thanks for joining me. Tonight, I'm joined by Neville Mandimika, Africa analyst at Rand Merchant Bank. Neville, thank you for joining me.
Thanks for having me.
I'll start out by saying Happy New Year.
End of January.
End of January, tricky. I figure you can still say that until like March. So
Possible.
I'm going to take it and run with it. Hope you've had a good start to the year.
Yeah, it's been good.
Okay, on that note, where are we in terms of outlook? Are you feeling bullish for the year? Are you feeling bearish? Where do we sit in the scale of things?
Look, we're a little bit more excited in 2017 compared to where we were in 2016 now.
That's a good start.
Which is a good thing in the sense that, you get quite a number of countries, at least the ones that are within our portfolio of focus countries, that are doing relatively well. Some of the risks that we are cognizant of this year are not as exaggerated, or at least hopefully, compared to the risks that we're focusing on last year. It's calmer waters, if you can call it that.
Is the general positive outlook then a function of both internal dynamics of different countries, but also a more stable global environment? Not geopolitically, of course, but a more stable macroeconomic global environment?
Look, I think it's a bit of both in the sense that the big theme with Africa is obviously commodity prices. The big ticket items, your oil, your copper prices, etc. They're starting to stabilize, and in some cases actually starting to shoot up, which is a good thing. But on the other hand, you've got a lot of idiosyncratic factors that are doing well, or at least positioned to do well, in the sense that if you look at your Ghana, your Zambia, for example, those are the countries in which the countries themselves internally are taking positive steps in order to de-risk their relative economies.
Okay, let's start south and start with Zambia. What are they doing? What are they doing right in your envision that RMB is positive on, and broader investors should be positive on?
If you look at the current administration in Zambia right now, late last year, just as an example, during the campaigning phase of the elections, there was a very strong rhetoric from both camps in terms of we want to make Zambia's growth rate a lot more sustainable. So that theme has been carried through with the winner now, the current administration. From a finance ministry perspective, where we saw late last year, there was a removal of fuel subsidies, which was a good thing for us because that was quite a strong burden on government finances.
Right.
Into 2017, the rhetoric of removing electricity subsidies is actually a very key theme at this stage in Zambia. So there seems to be the political will, which is always necessary to enact serious reform in these countries. So there is that drive internally to actually ensure that Zambia is actually doing well in the medium term, which we forecast is going to do particularly well.
I guess a key question then in that is, are these policies a function of an IMF program that's going to be imminent and it's going to force them to enact these reforms, or am I giving government a little bit, am I being too harsh? Should I be giving them more credit? They're actually being proactive.
Look, I think it's again a combination of both. The IMF, coming in specifically in Zambia, you saw that like we spoke of, the fuel subsidies being removed, in our view, was preempting that, so that the authorities could have a stronger footing in terms of negotiating the details of that package. But again, the fact that the IMF in the recent past has been extremely critical of the fiscal path that some of the African economies have taken, and obviously look to remedy that as part of the conditionalities of their program, is obviously a very interesting key point for them in terms of the negotiating, the back and forth that is going to happen. But again, it's a combination of both. There is the political will, and there's obviously Big Brother coming into town with certain conditions attached to the money.
Before we get to some of the other positives, isn't a big risk associated with removing subsidies then that we are likely to see a ramp up in inflation?
Well, it's a question of how it's done. In the case of Zambia last year, we saw that the authorities took advantage of the base effect drag,
Right.
which was simply the dragging down of headline year-on-year inflation, simply because there was a blowout back in 2015.
Right.
So from that perspective, they timed the removal of subsidies quite nicely, in the sense that the uptick in inflation, or the inflationary pressures, were masked by that readjustment in terms of the index.
Okay.
So that was quite nice. Now the rhetoric that is starting to filter through is, how are they actually going to restructure the electricity subsidies removal? What we would like to see is obviously a phased approach. You don't want to shock the consumer, by telling poor old Joe on the street that his electricity bill is going to be 50% higher in the next month.
Right.
So a phased approach obviously would be first prize for us, in order to actually ensure that inflation expectations are well anchored.
And will this likely affect the currency? It's been a lot more stable of late.
Well, it's positive sentiment for us, the way it's been handled right now, and you can see that the market is starting to put a little bit of faith in the authorities. It's been one of the most stable countries in Africa. It's poised to actually do well. It did actually strengthen against the dollar last year,
Right.
which is a good thing. So the market is actually starting to reward that. If you look at some of its yields, etc., they're reflective of that. So at this stage, with what we are seeing, with the risk matrix that is in front of us, it is a question of how they manage that. And our view is that they're going to do relatively well. Obviously, there are a lot more assumptions there, but they're going to do relatively well, and the currency would be a beneficiary of that. But again, one point that is quite interesting is, how is the IMF going to? Are they going to change any FX policies that are currently in play right now? Are they going to insist on more or a better free play of within the interbank market? Is that going to result in volatility of the kwacha, against a backdrop of improved sentiment? So how will that all aggregate together at the end of 2017? That is a key question, or a key dynamic that we're currently looking at. But at this stage, we're not too worried about a currency blowout. It looks well anchored.
Okay, I'm going to choose to believe you. I'm going to be positives of Zambia. If I'm looking at it as an investment destination, what are the key industries that I should be focusing on? Is it a mining story, or commodity story, or is it broader than that?
Well, at this stage, it is a commodity story. We can't discount that simply because of the composition, or the weight that the mining industry actually carries within the GDP number itself. Right. But at the same time, you see that the consumer sector, the retail sector, is poised to do relatively well, in the sense that inflation is now down in single-digit figures, which is a good thing for the consumer. You've got the agriculture sector that is doing quite well. If you look at some of the maize yields and the maize harvests that are coming out of there, so there are those key components that are actually pulling together in the right direction to actually drag economic growth to the 3.7 mark, in which we're focusing for this year.
Okay. Let's move to Ghana, another country you've touched on. Where is Ghana right now? What's driving your positivity?
Ghana is in a very interesting space, in the sense that they are almost 2 years into an IMF program, right. And they've been doing quite well in terms of the targets and the benchmarks that have been negotiated from both parties, the authorities and the IMF. We've seen a successful transition of power from a political perspective, which obviously de-risks the economy from that perspective. At the same time, you're starting to see the gold industry, oil industry doing particularly well, either building up capacity there, and also the revamp of oil prices into 2017. So those sectors, it's driving our optimism on a relative basis, again, which is a very interesting thing within the West African region. If you want to get a play within there, your big options would obviously be your Nigeria and your Ghana. Nigeria is obviously experiencing a little bit of some turbulence at this stage. So you could get some exposure within Ghana. So from a fundamental perspective, in terms of what they're doing right, and also from a relative perspective, Ghana is poised to actually do particularly well this year.
Okay, we've spoken to commodity driven economies, and I guess from an investment perspective, you're probably leaning towards commodities. Does that mean that we're now experiencing a shift from an outlook perspective on commodity-driven economies and sectors, or rather from investment-driven sectors to commodity-driven ones?
Look, I still think that there's a lot of value within the investment-led economies, in the sense that if you look at the dynamics within the East African region, for example, they're doing particularly well. They were shielded from the commodity downturn. They've got, a lot of them have got diversified manufacturing base, export base is fairly diversified, which obviously de-risks them.
Right.
So from that perspective, you'd want to still get some exposure into the investment-led economies, because in terms of just headline GDP growth, they are going to outperform the commodity-led economies.
Right.
But the interesting thing is it's the commodities that are going to experience a much sharper rebound, although still underperforming investment-led economies. So you obviously want a bit of both within your portfolio, whatever that portfolio would look like, simply because there are positives from both camps, commodities and investment-led.
Okay. Let's now framework the risks for investors on the continent for the year ahead. It's been a volatile couple of years. What are we looking out for from a risk perspective in 2017?
The key thing, again, just keeping with the theme of commodities, given the dependence of Africa in general on commodity play, then you obviously want to have a serious look in terms of whether there is some unforeseen downside in terms of commodity prices.
Right.
So China then becomes a very critical component within that.
Right.
You'd also want to have a look in terms of the climatic conditions. So within your East African region, climatic conditions are a notable risk. We've moved on from El Nino, now we're at La Nina, which is a lot of rain, which again can affect agricultural yields.
Right.
From some of the East African regions. Security risks are a consideration that we have to keep our eye on. Kenya would be at risk of that. Nigeria would be at risk in terms of some of the camps, extremist camps that are operating within those two regions. Whether they make inroads or not, that will be a dampening effect in terms of the sentiment that has been built up so far. So I think those are the three risks that would be particularly cognizant of this year.
Perfect. Let's leave it there. Thanks to my guest, Neville Madimika, Africa analyst at Rand Merchant Bank. That's all from Buy Africa this week. Remember to follow me on Twitter. That's at Mudiba_Tsepo. And Neville, yours is?
At Nev Madimika, and also RMB Africa Twitter account.
Perfect. Please send us your thoughts about the show using the hashtag Buy Africa. From myself and the team, goodbye.